In 1997, Thailand made one decision that triggered an economic earthquake across Asia. For years, Thailand had pegged its currency, the baht, to the US dollar. Foreign investors poured billions into Thai real estate and stocks. Banks borrowed heavily in US dollars. Growth looked unstoppable. But there was one hidden problem. The money wasn't productive, it was speculative. By early 1997, Thailand's real estate market was overheating. Exports were slowing. Foreign debt was rising. Investors began to panic. On July 2, 1997, Thailand abandoned its currency peg. The baht collapsed. Within months, Indonesia, South Korea, Malaysia, and the Philippines were hit. Currencies crashed 30–80%. Stock markets collapsed. Companies that borrowed in dollars suddenly owed double in local terms. Indonesia's GDP contracted by 13% in 1998. South Korea required a $58 billion IMF bailout, the largest in history at the time. Millions lost jobs. Political systems fell. Why did this spread so fast? Because capital flows move faster than governments. This wasn't just a currency crisis, it was a confidence crisis. When investors believe a country cannot defend its currency, they exit. When everyone exits at once, the system breaks. The Asian financial crisis changed global finance forever. Countries built massive foreign exchange reserves after 1997 to never depend on the IMF again. And today, whenever we see emerging markets with high dollar debt and fixed exchange rates, economists remember 1997. Because confidence can collapse overnight. At the micro level, the crisis was devastating because firms had borrowed in US dollars while earning revenue in local currency. When the baht depreciated by over 50%, the real value of their dollar-denominated debt doubled instantly. This is called currency mismatch risk. Imagine a Thai company owing $10 million. Before depreciation, repayment may have required 250 million baht. After depreciation, it required 500 million baht. This caused mass bankruptcies. On a supply-demand currency graph, investor panic shifts supply of domestic currency outward as investors sell it. The exchange rate collapses. Firms face rising costs of imported inputs and debt repayment. Profit margins disappear. Micro lesson: exchange rate risk management and hedging are critical for firms exposed to foreign debt. At the macro level, the crisis was driven by sudden capital flight. When foreign investors withdraw funds simultaneously, foreign exchange reserves fall. Governments cannot defend currency pegs. Thailand's reserves fell rapidly before the peg collapsed. Contagion spread because global investors treated emerging Asian markets as a single asset class. Once Thailand fell, investors withdrew from Indonesia and South Korea preemptively. GDP contractions were severe. Indonesia, 13%, 1998. Thailand, 10%, 1998. After 1997, Asian economies accumulated massive foreign reserves as insurance. This explains why countries like China and South Korea today hold trillions in reserves. Macro lesson: open capital accounts without strong financial regulation create systemic vulnerability. Subscribe to Econ Matrix, where economics meets reality.